Good morning, everyone, and welcome to the session today to discuss how technology has become a game changer for financial consumers. My name's Charlotte Ransom. I'm the co-founder and CEO of Netwealth, and I'm joined by Matt Conradi, who runs our client advisory team and has been with us since the start with me. We launched Netwealth 4.5 years ago, really to address exactly what we felt was missing, a service that could combine great modern technology with the best bits and possibly the more human bits of traditional wealth services. Today, we're going to talk about how this combination can drive much needed change, as well as discuss what the potential risks are that we should be trying to avoid. Matt, perhaps it would be useful now to remind ourselves of just how much things have changed over time.
Yes, thanks, Charlotte. I mean, technology has been something that's been impacting investors and markets for a long time. What we're going to look at quickly now is just some of that timeline that has occurred. I mean, if we think back to the 1800s, in the late 1800s, there were some really revolutionary elements of technology coming in that drove better transparency and efficiency. If we think about ticker tape machines in 1872, this was the first time that you could get virtually instant share price information sent around the country. In both the US and in markets like the UK as well. Through the sort of 1900s as well, we started to get more information, more sharing, more ability to understand what pricing was, to help with trading and so on. But that was really on the institutional side. It wasn't really until the 1990s and the internet where we started to see an impact for more consumers, for retail investors. There was the launch of the first online brokerage in the US, eStar Trade, that was a way for people to access markets efficiently and in a more cost-effective way. And that's really what we've seen since the 1990s, is more increased access to markets and lower costs for investors. But it's very much about investing. We saw the launch of Hargreaves Lansdown's online platform in 1999, for example, when we were having that whole dot-com tech boom as well at the same time. But where we haven't seen a great deal of technological impact or improvement is in the wealth management industry. So we haven't seen that come and support in other areas. In fact, wealth management firms providing advice and support around the edges of it for investors are really stuck with the similar levels of technology that they had many years ago. They haven't taken that leap forward. We've had a little bit of that with the rise of things like robo-advisors in the US, who are trying to think about technology, but perhaps we'll see later on that they haven't solved the answer yet. And we'll start to see that these benefits of transparency and lower costs, whilst they can be really helpful, they're not the only solution that's required over time. So that's the sort of idea of how technology has been there and improving period on period and making a difference, making it easier for investors, but there's still perhaps more to go as we move forwards.
Yeah, I think that's an interesting point in terms of how fast things are moving. And actually, one of the things that we've certainly seen is how quickly expectations are evolving. And maybe that's particularly true as a result of being lived through the pandemic during the course of this year. And in fact, I think what I'd like to do is just pull up some stats that we got from a census-wide survey we did of 1,000 investors during the course. This was after the first lockdown, and obviously before the second. And what this really tells us is that there are several themes which were already underway and have been accelerated. So what you can see on the left-hand side of the slide is that overall investors really want to have far more control and transparency. And the way that this is expressed is through a variety of things that they were asked to respond to. So first of all, the ability to be able to track their portfolio performance 24/7. 70% of people now expect that. And although that sounds like an obvious thing, in fact, it has been quite difficult for financial consumers to have proper insight in terms of how their portfolios are and what the drivers are between either positive or negative performance. People also want to be able to manage their holdings online. And this is something that we saw made an enormous difference during the pandemic. And what does that mean? Well, for example, if somebody is in drawdown in their pension and they are concerned about the degree to which markets have moved against them, it might be the time that they would like to stop those payments being made, use the cash that they've kept to one side for those, for exactly those types of periods when things are difficult, and then potentially change the amount that they want to draw every month during a period while they are, anxious about what the markets are doing for them. The other point is access to online financial planning tools. So over half of people are now more aware of the fact that they can probably get better access to financial planning tools that can really let them drill into the requirements that they have and make an assessment of, are their plans evolving in the way that they would expect? Are their expectations too high? Are they able perhaps to put a little bit more aside in order to rules that they have? And having access to that type of information is very important in terms of the general level of confidence people have in financial planning. And then the last bit, access to research and market commentary, that I think is interesting that it still achieved a high mark, because you would have thought that it is ultimately, there is an overload in some respects of market commentary and research. So, part of our reading in this was that people are not being delivered this type of information in a way that's readily digestible. So that's what we found in terms of investors' expectations changing. And I think maybe on the right, it was also interesting for us to see why investors are considering switching and why they might decide that the current provider they're with is no longer necessarily the group they want to stay with. And what you can see is that the two highest areas of concern are poor investment returns and high fees, both of them scoring, as you see, 59 and 55% between them. And the poor investment returns question is an interesting one, because we all know that markets have been through a very difficult period, and therefore any investor will have seen a high degree of volatility. But it comes down again to the fact that there's perhaps a disconnect between people's understanding of why their investment returns have been poor. And that comes back to this question of transparency and communication. And it also is a question of how much they're paying for their service. So their net returns will be dramatically affected by how much they're paying for that service. Now, as a separate point, there is great acknowledgement that high fees is a reason potentially to switch advisors. As you can see, over half of people are proactively looking at that as a reason. Going back to one of the things that we particularly wanted to address today, which is that technology can help deal with a number of the different things I've just been talking about. But we also believe there's always a place where human, and particularly human advisors, can be of particular importance to consumers. And so it was interesting for us to see that there were 18% of people suggesting that they would switch due to poor advice, which absolutely right. If you're getting poor advice, you should switch. But in fact, the overriding emphasis that we got back from people is that they do want still to have access to human advisors. And perhaps one of the most interesting statistics for me was seeing that 41% of those surveyed who were DIY investors now consider access to human financial advice more important than ever before. Matt, that's interesting because you obviously run that side of our business, and we have very deliberately built a hybrid service that can help both address the sort of the technological requirements to drive those improvements, but always have the ability to talk to a human advisor at the same time. So maybe you could run through the summary of that, and then we can get into a bit more practical demonstration of what we mean by the things that we've brought up so far.
Definitely, Charlotte. So, I mean, what we've seen here is that investors expect technology to be there to give them some of the main benefits that we want from that as well. Because if we think about the role technology can play, why it's a game changer is it can help to keep the costs down. Technology used in the right way by firms should mean that for consumers, they get lower cost access to investing, to wealth management, to advice along the way. It should be able to give us really helpful portfolio and planning insights. It should be able to help to visualize that. And we're going to show particularly how that can be such a game changer for helping to make more informed decisions later on. That with enhanced transparency about portfolios, whether you're managing your own investments or whether you're looking at investments managed by someone else, you should be able to get better transparency and information. Now, it used to be that your investments were over there somewhere else being managed by someone else, and you got a little bit of info once a quarter, or perhaps if you were lucky. And now you should be able to get daily information about what's going on, what's being done either on your behalf or you're doing in your investing. That should equally be supported by more efficient processing. So they should be able to deal with requests, process trades, switch in accounts, change drawdowns, like Charlotte was mentioning before, all in a much more efficient way, rather than these paper forms going out and long, slow processes. There's still a long way to go. Anyone that's been through a recent pension consolidation or an ISA transfer still knows that it's a little too paper-based and a little not enough technology is being used yet, but that's where technology can really improve the experience for people. But equally, technology can help us disseminate more information and guidance. For those of us that want to think about investing and dealing with ourselves, we should be able to get better access to information, because all of this should help you make more informed decisions. Now, let's think about that technological side. We will touch more on how it can help with an advisor and why there will always probably be a role for human experts along the side to help with either investing or with planning. But technology can certainly make you make more informed decisions about that. So let's have a think about specifically how technology plays that role and where in particular it might be able to do that. So let's have a look at an example now. So let's think about now how the role technology can play in and how it can be a game changer when we're thinking about making decisions for planning for the future. Because when we're investing, of course, we're trying to get better returns, but we're generally investing for a purpose, for a goal. And where technology can really play its role is helping us to make more informed decisions about our goals. It can give us better insights into the choices we make so that we can be more likely to achieve our goals, but be more comfortable with those trade-offs. We're looking here at a scenario where someone's trying to plan for their retirement. And in fact, let's look at their goal in the first place. Well, they want £2,500 a month of retirement income. They're going to inflate that by 2% because it's a really long-term goal. So they've got to factor in inflation and understand the impact that has. And again, that's where the technology can help you just really see that intuitively, because it's not necessarily intuitive to think how much inflation is going to have an impact over time. Well, they're 60 today. They want to retire at 65. And then they're thinking about 30 years worth of income. 30 years worth of income takes them to 95. It's prudent to understand the impact of living a long time into the future. So they're then thinking about how much they've got to contribute. Well, they've got what they've got. They've got 500,000 today, but they can think about how much to contribute between now and retirement. So for 5 years, they're going to plan to save £1,000 a month net into their pensions in retirement. Then they can also think about the level of risk they want to take. And here we show 7 risk levels. That's the way we think about risk at Netwealth, 7 multi-asset portfolios across a range of different levels of risk. But what does risk mean? It's really hard sometimes for clients and individuals to understand risk. When you're thinking about a fund, how do you know where that should fit in the profile? And what does that mean? Well, risk, why does it matter? Risk matters about the level of fluctuations you're going to experience, whether you can be comfortable with them, whether you can withstand them, particularly when you're thinking of a goal like retirement. When you're drawing down, you don't want it to fluctuate too much potentially, but also you're going to be comfortable with them. So what the technology does is it helps us show you the impact of that. There's the transparency part that we talked about before that's been building up over the years. More and more transparency has been available to understand the asset allocation. So we look here, the blue section is fixed income, the green section is equity. And technology now makes it easy to drill down into that, to understand how much is in the US, how much is then in a different fund and so on. And then you can always click on these things and get fact sheets. And you'll all be familiar with that approach because the platforms have done a great job at making it easier to get this information. What doesn't necessarily always come out is, well, what does that actually mean? I'm making a decision about investing in this for a goal. Well, what does that mean for risk? And what we show here is the range of returns that could occur. So the best 12-month return and the worst 12-month return. Technology helps us make it personal to you. So in this instance, that person seeing that in a risk level 4 balanced portfolio, the worst 12-month return happened between October 2007 and October 2008 would have fallen 19.9%. But what does that mean? That means £99,450 for someone who's got 500,000 to invest on day one. But they can also see that markets recovered pretty quickly after that drawdown, and they had a positive period. In fact, their best 12-month period came pretty much straight after that worst 12-month period. But they can start to make more informed decisions about where to be on that risk spectrum. What happens if they go up to risk level 7? Now they've seen that, well, firstly, taking more risk means more equities, more green on that pie chart, more equity investments. Taking more risk also means average annual return in the past has gone up. The best 12 months has gone up, but the worst 12 months has gone down. So there's going to be more risk on the downside. And again, putting it into the individual circumstances, instead of the worst 12-month period equating to minus 99,000, now it's minus 156,000. They can see that trade-off. You can also see the trade-off if they go down the risk spectrum and what that means and how that would trade. And that's great to see what history does. That can help you make more informed decisions about the level of risk you're comfortable with. But where technology really can change the picture is when you're doing something like cash flow modeling. So we're looking at that goal, that objective, and we can see whether it's realistic or not. And then we can decide if we need to make changes, which ones are the ones we want to do, which ones are the most relevant for us individually. It's all very well to read and say, well, the best thing you can do is defer your retirement, or the best thing you can do is take more risk. You want to understand, what does that actually mean, and are you comfortable with those decisions? So let's look at them as some of those scenarios. In this case, we've got a range of returns that can occur. On the left-hand side, there's a chart here that shows you stronger returns, weaker returns, average returns, because it does matter, the range of returns, and we know markets go up and down and they fluctuate. But in all of the instances, they're not going to achieve their goal. They're not going to have enough income. So they're going to need to do something. So how can they make a choice about the right thing to do? Well, the first thing they could think about doing is maybe changing their risk. What does it mean if they were to go up to risk level 6? They can see what that means historically. They're going to have to accept that it's going to fluctuate more, and that those drawdowns, when they happen, those negative periods are going to be larger. But hopefully that would mean more return. Well, let's look now what that means to the projection, modeling forwards. What can you see? Well, we can see that on average now, they might actually be able to achieve their goal. But they've got a much wider range of outcomes, because what taking more risk does is it increases uncertainty. You're going to have more potential upside, but more potential downside as well. And so perhaps in a goal like retirement, you're not prepared to have that level of uncertainty. When you're in accumulation phase, perhaps you're happy to have that uncertainty when you strive for more return. So what are the other choices they can make? If they want to go back to their risk level 4, because that's something they're comfortable with, well, they could think about putting more income into the pension in the time before they retire. So let's think about putting 2,000 a month in and staying in that risk level 4 position. What does that do to the outcome? Well, it's better than it was before they put the extra £1,000 a month in, but it's still probably not enough for them to achieve their outcomes. So what else could they do? Well, they could, for example, defer their retirement a little bit. So they're 60 today, they could defer their retirement to 67. And then they could think about only needing 28 years worth of retirement income now, rather than the 30 years to take them to 95. So in this scenario, they're going to have 2 more years to save towards their retirement, and they're going to have 2 years less of retirement income that they need to get to the same age. What does that do to the overall picture? Well, we can use the technology to see that actually that means that it's more achievable. It looks like on average, they're going to be able to achieve that goal, and they didn't need to take any more investment risk. Now, every individual will view that differently. Some will say, look, I'm not going to be able to save more money. I'm going to take more risk. Or maybe they're going to reduce their income. The point is that technology makes it easy for you to understand the trade-offs and make much more informed decisions. It's always going to be helpful as well to speak with an expert around these areas, to understand what the right mix might be, to think about other things that you could do, like tax wrappers or savings and allowances that you can make the most of in order to do this, how you draw down from your pension as well, for example. But technology has really made it much more intuitive and much easier to understand the impact of a goal. The same is true once you are invested. So this is the modeling phase and where technology can really be a game changer. But let's think about what it's like once someone has invested and they have a portfolio. Well, we talked about at the beginning, over history, we've seen more and more transparency of information, better data. So this is a system that's going to give you a refresh overnight, every night of your position. It's going to be super quick and easy to see across all of the different accounts you've got, pensions, taxable accounts, ISAs, and so on. What's my overall currency position, for example? So you can see that this person's got 37% in US dollars. And so if they are concerned about what might happen to the dollar versus sterling, they can do something about that if they want to. But also they can get more understanding of the drivers of return, perhaps. So if they want to, for example, look at their sterling portfolios and then look at the performance that they've had over time, how does that look over the last 12 months? Well, they can see here, yep, it was pretty negative in March. That's because this is predominantly invested in equities, but then they've bounced back quite a long way since then. So if they made an adjustment to their portfolio in March, they wouldn't have necessarily recovered back over this time. But if they did something like Charlotte talked about before, which is reducing their drawdowns, they might now be able to increase those again and make a change to the mix. They can see where the sources of return came from as well. So transparency is understanding, well, okay, what's driven change in values in my portfolios? Is it because I've taken money out, made withdrawals? So in this instance, this chart shows you the yellow line is the net contributions and withdrawals, and the blue line is the portfolio. And it's fallen in value, but that's because you've taken money out. Where has the return come from? You can drill down and you can see sources of income or capital gains and losses. You can see individual positions, which ones have been good performers versus bad performers. So we can see that credit's done quite well in this portfolio over time, but short-dated corporate bonds haven't done as well because they haven't had as much sensitivity to interest rates. Similarly, you can do things like look at scenarios. To help you make more informed decisions, you can understand, well, what would be the impact of a rise in interest rates? What happens if that's a negative rise in interest rates? This scenario analysis tool helps you see, if you rerun a historic scenario of interest rates rising, which was in the early part of 1994, what would that have done to the portfolio? Well, we can see in total, it would have meant a fall of 6.7%. But let's also think about a scenario where you get a more positive rise in interest rates. For the same level of interest rate rise, now, because it happened in an environment where economies were improving, the world backdrop was looking better, and it happened over a longer time period, actually the portfolio would have risen 35%. So it helps you understand that interest rate rises don't necessarily always mean the same thing. This is how technology gives you transparency, gives you information, and makes you make more informed decisions. Similarly, if you've had goals that you've set up, being able to understand whether you need to make adjustments can really help you make more informed decisions as well. And getting that visual element can make it more intuitive for someone. So they can see, for this person, their goal of their retirement income is not really achievable. So they might need to adjust their target down to 3,000 a month from 6,000 a month. By doing that, they can see, well, this is what's going to happen. I can prepare now that in 7 years' time, I'm going to have to expect 3,000 a month. That looks quite achievable. Fast forward, perhaps they're in a tough market environment and they're thinking about cutting their risk. Well, they can see what it means if they cut their risk. If they took their risk level down to 3, so they took out a lot of equity investments, they need to be aware that by doing that, they're going to reduce the likelihood of achieving the returns they need to achieve their goal. So that chart there on the right-hand side has got much narrower. They've got more certainty by taking less risk, but they're much less likely to achieve their goal. Again, you can make more informed decisions about these changes you might want to make. But it's exactly where equally you'd want to sometimes speak to expert advisors as well. And I think I'm going to stop showing the technology there and pass over to Charlotte, who will be able to think about how this fits together with experts as well, whether that be for investing or for planning along the way.
Yes, hopefully we're able to do with showing what the online version of some of our tools looks like, gives you a sense for the accessibility of some of these tools. But as Matt said, and actually as he demonstrated, it's also important to have the human element and to be able to sort of check up that we're thinking about these things the right way. Have, in a sense, somebody whose professional background is there to help make make those important decisions with you as and when necessary. So in fact, one of the things that we're a firm believer in is that advice is not necessarily something that people need every year bundled into the overall fees that they pay, but that it is something that is likely to be of use at different points in people's lives. So, very often it's things like the point somebody decides to retire, or there's a divorce, or there's an inheritance. There are different times in our human advice, and professional advice is very important. And in fact, backed up by these tools, it helps to make that all the more clear. So to finish up here, we have a slide which helps show how we see modern wealth management, with technology really complementing expert advisors. We've discussed and demoed a number of the positives that come with great technology, and they're largely laid out in the bottom half of the circle here in grey. I believe there's so much to be gained from consumers being able to have far more transparency and ultimately control over their investments, even if they're not managing them themselves. User-friendly and intuitive tools give us all a much better sense for what we need in order to set our financial goals and then ensure that they stay in place. And again, this year, we've had a perfect example of how important that is when markets and the general environment become suddenly, much more difficult to navigate. If there was a better understanding of financial outcomes, I think we'd have fewer people holding long-term ISAs in cash or trading out of markets right after a big sell-off, and we'd be more likely to recognize and temper these type of very typical human emotions. Human advisors can come in to avoid the risks that technology alone can't always counter and may even exacerbate. So for example, having complete transparency and being able to see, if you want, every day how something is performing may also be the type of thing that would trigger somebody to sell at the lows or to panic when they don't need to. So it's really a question of trying to avoid some of those behavioral mistakes, particularly when it comes to longer term planning and making sure that those very important sort of big picture goals are understood in the context of everything that's going on around us. So I think what advisors do, they can overlay a level of nuance and interpretation that's very hard to deliver via technology alone. But we're at a point where personal finance has never been so accessible, so understandable, so needed. Rates are at all-time lows. We have pensions freedom. We have a very expensive property market. So for all sorts of reasons, we need to make the most of the money that we already have and that hopefully we'll go on to earn, and ensure that we can make it work as well as possible for us to achieve those long-term financial goals. So I hope you enjoyed this session to explore how technology is a game changer in the world of wealth management. And please remember, we've got a virtual booth here. So please come and chat with the team if you'd like to find out more, or visit our website at netwealth.com, or with us via contact@netwealth.com. And hopefully through any of those different forms of communication, you'll be able to work with us, find out more about what Netwealth might be able to do for you. Thank you very much for listening.